Ladies and gentlemen, good day and welcome to Renaissance Global Limited Q3 FY21 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Akash Mehta from Dickinson IR. Thank you, and over to you, sir.
Good afternoon, everyone. I welcome you all to the Q3 and 9-month FY21 earnings call of Renaissance Global Limited. We have with us Mr. Sumit Shah, Vice Chairman, and Mr. Hitesh Shah, Managing Director. The discussion today may include some forward-looking statements and must be reviewed or considered in conjunction with the risk in the industry in general and our business in particular. Now, I hand over the call to Mr. Sumit Shah. Over to you, sir.
Good afternoon, everyone. On behalf of Renaissance Global, I extend a warm welcome to everyone on this earnings conference call to discuss our performance during the quarter. I'd like to give a quick overview of the company, followed by a review of the financial performance during the quarter and the 9 months ended 31st December 2020. After this, we'll take questions from participants. Our strategy is to grow our business through licensed brands and own brands globally. In Q3 FY21, branded and licensed brands revenues contributed 23% of our total studded jewelry revenues. Our strategy is to continue to grow our share of this business. The company is focused on branded jewelry through our exclusive licensing arrangements for Enchanted Disney Fine Jewelry, Disney Treasures Fine Jewelry, Star Wars, Hallmark, and our own brands, Made For You lab-grown diamonds, Jewel Lily, and Iraswa. The much anticipated launch of Enchanted Disney Fine Jewelry in mainland China through the deal with Lao Fengjiang, the second largest retailer in China, has been finalized. We expect to ship our first order in Q1 FY22. We're also excited about the growth of our direct-to-consumer business. We launched the direct-to-consumer business through our online websites exactly a year ago. Our direct-to-consumer business through the newly launched websites has shown robust growth during the quarter. In Q3, the direct-to-consumer revenues were at 27 crores with an EBITDA margin of 16%. Based on our estimates of the quarter's contribution to annual sales, we're at an annual revenue run rate of 70 crores for the year. We expect the direct-to-consumer business margins to improve going forward to the 20 to 22% range. During Q3 FY21, we launched Star Wars Fine Jewelry direct-to-consumer website for customers. We are highly encouraged by the consumer response. Based on January-February month-to-date sales data, the direct-to-consumer business is now trending at an annual run rate of greater than 100 crores. Our direct-to-consumer plans also include launch of website for Disney Jewels and Hallmark. The D2C business is a high gross margin business with margins between 55 and 60%. In summary, we had a quarter where sales degrew, but we feel that the normalization of the sales process has now happened, and we expect FY22 to be a normalized year. I'd like to turn the call over to Mr. Hitesh Shah for a discussion of our financial performance.
Thank you, Sumit. Good afternoon, everyone. The company during the third quarter of FY21 reported a total income of rupees 741 crores against rupees 890 crores during the corresponding quarter of the last financial year, a decline of 17% year over year. Our Q3 FY21 EBITDA is at rupees 48 crores, while our net income stands at rupees 26 crores. For the 9 months ended December 20, our total income is down 29% at rupees 1,463 crores versus rupees 2,056 crores last year. However, our gross margins have improved 40 bips. 9 months FY21 EBITDA stands at rupees 81 crores versus 9-month FY20 EBITDA of rupees 145 crores, a decline of 44%. Our net income before discontinued operations for 9 months stands at rupees 30 crores against rupees 83 crores in the same period last year. We expect revenue growth for the Q4 of FY21 to be in the range of 0 to -10% as compared to Q4 FY20. However, we expect net income to increase meaningfully in Q4 FY21 as compared to the same quarter last year due to contribution from licensed brands as well as direct-to-consumer business. Further, we expect net income and earnings per share to grow in double digits in FY22 as compared to FY20, implying normalization of business. The company has managed to lower its net debt to equity levels to 0.36 in December 2020 against 0.51 in December 2019. Further, company's trailing 12 months return on equity stands at 5.1%, which was at 13.5% for the year ended March 2020. Our long-term goal is return on equity greater than 15%. In terms of geographic bifurcation, USA contributed around 67% to our overall revenues during Q3 of FY21, with 25% coming in from the Middle East. For the 9 months ended December 20, the breakup was US 63% and Middle East 24%. In terms of product category, studded jewelry contributed 79% to the overall revenue during the quarter, with the balance coming from the plain gold jewelry segment. For the 9-month period, studded jewelry contributed 81% to the overall revenues. Thank you very much for your kind attention. Now floor is open for Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Shruti Sharma, an individual investor. Please go ahead.
Hello.
Yes, go ahead.
Hello.
Go ahead,
Go ahead, ma'am.
Yes, sir. Good afternoon, sir. Thank you for taking my question. Sir, I just wanted to understand the broader view on the market perspective, like how is the market looking and are we seeing the demand coming back in the market, or how the Diwali season has been for us? Was it a pent-up demand or the normal demand we are seeing which has come up in the market again?
Sure. So I'll take that question. So I think what we are seeing in the US, which is our largest geography, is some normalization of demand. I think that during Q3 we saw gradually sales recover back to pre-pandemic levels, and there is still some decrease due to offline stores not being at full capacity. So I would say that there is normalization probably in Q4. As per our guidance, we should be between 0 and -10%. We don't have too much exposure to India because we have only 3 stores currently operating, so we would not be in a very good position to give an outlook on demand scenario in India. But globally, we are seeing normalization, and due to the vaccine rollout, we are quite optimistic that things should normalize to pre-pandemic levels in FY22.
Okay, sir. And so, how is our online business shaping up? What kind of revenue targets do we have for FY22 and 23 from this particular segment?
Yeah. So there is significant tailwinds to the online business. We've seen during the course of the the 9 months that we've operated the business, that revenues have grown meaningfully. We launched our business only in February of last year, and business has grown from an annual run rate of 25 crores in the first quarter that we started to a 70 crore annual run rate. And that has further improved in the current quarter since we have data for January and about 13 days in February. Currently, the run rate is well over 100 crores. So I think having started the business about a year ago, we're very encouraged by the progress of the direct-to-consumer business, especially the impact that it has on our blended operating margins.
Okay, sir. And so I just wanted to understand one more thing on this. That is this business is here to stay? I mean, do you think the customers which are coming are going to be the sticky customer, or once the things normalize, they will again move back to our brick-and-mortar model?
So our anticipation obviously is that a lot of consumer habits will change. The tailwinds that we have to the business may normalize. We may not see this kind of exponential growth once things open, but I think that a lot of customer behavior that has changed. Our anticipation is that it is likely to remain going forward. But again, it's something that's to be seen, and we'll have to see how the year plays out.
So that means that we might see some shift in the business model going forward if we see that this online direct to customer is, getting the sales through this channel is higher than our brick and mortar. So we would want to curtail that, or how things are going to move for us.
So I think we're, as a company, we're extremely focused on growing both the wholesale as well as a direct-to-consumer part of the licensed brands, because that's where the company makes higher margins. Currently, we're operating 4 websites, and the plan is that there is 2 other licensed websites that are to be launched during this calendar year. We have Hallmark Diamonds as well as Disney Jewels. So we anticipate robust growth in this segment during FY22.
Okay, sir. And so on the China front, I think we have signed the agreement with LFX. So what kind of revenue targets are we anticipating from this particular chain?
So I think we're launching our test, which is for 150 doors in Q1 of 22. I think once the test is successful, only then will we be able to give guidance on what kind of revenues we're anticipating, because at this moment it's a test with 150 stores. I think we'll be in a better position at the end of Q1 22 to be able to give some guidance on what kind of revenues we expect from China.
Okay, sir. And so, on the India business, how are our brick and mortar, like the 3 stores which we have, how are they performing? And, in FY22, as you earlier mentioned that we have plans to open new stores. So do we have plan to open any other store in any newer geography in FY22? Are we going to stick to that, or, we might see some delay in the opening of stores?
So currently, we are evaluating the demand since the new stores have only opened 3 months. Currently, the 2 new stores that we've opened are slightly below break-even level. So we'd expect to see some normalization in sales going forward, after which we'll finalize plans for expansion. So as of right now, there is no further plans of expansion till we see the 3 stores normalize and contribute at a unit economics level.
So, sir, by when do you think that the break-even will be achieved in these 3 stores which are newly opened? Any estimation if you can give?
I think we would be able to give you an update this quarter. I think that it's a little early to say.
Okay, sir. Thank you, sir, for answering my questions. If I'll have more questions, I'll come back in the queue.
Thank you.
Thank you. Next question is from the line of Siddharth Oberoi from Prudent Equity. Please go ahead.
Yeah, hi. So this is regarding the online sales. So did you say it was like 70 crores for the year and now it's 100 crores?
Siddharth, hi. I think for the year, the actual sales achieved were 5.7 crores in quarter one, 8.9 crores in quarter two, and 27.5 crores in quarter three. So I think it's about 40 crores for the current year. What we've tried to do is, so as to help you understand what the seasonality in the business is. What we're saying is that quarter one usually, based on the revenue run rate, was a 24 crore annual business. It was a 45 crore annual business in Q2, and it was a 70 crore annual business based on normalized contribution of Q3 to annual sales. So usually quarter three is 38% of annual sales when we take retail. So even though we did 27 crores, it doesn't imply that it's a 100 crore run rate business based on Q3. So we try to sort of put that into the presentation, that what the annual run rate is likely to be based on quarter three.
Okay. So, but percentage-wise, I think it's still very less compared to the overall revenues.
It is. So I think at a 100 crore run rate, which we see in January and February, it will contribute between 20 and 22 crores, to the operating margin, which on a margin basis is relatively significant to our overall business, which is why we thought to highlight it. In terms of revenue share, you are right. It's about 4% of our annual revenue, but it would be a much higher percentage of operating profit because the margins are 3 to 4x of our other businesses.
Okay, and what is the run rate? What is the growth, quarterly growth or annual growth run rate that the online is witnessing?
Yeah. So as I mentioned, it was in first quarter of this financial year, it was a 24 crore run rate business. It was a 45 crore run rate business in quarter two, and it was a 70 crore run rate business in quarter three. Currently, January, February, what we know month to date is it's currently trending at 100 crore plus run rate, and we plan to launch 2 more websites in the current year. So those numbers are not in the current numbers, and would add to revenues. So at the current revenue run rate, we are seeing an annualized 100 crore business with a 20 to 22% operating margin on the direct to consumer side.
All right. Okay, and this is regarding the China tie-up. So you said that initially you'll give a sample, and then this will probably scale up. So have you set up a timeline where probably in Q1 you will supply this, and then based on the demand they will give you orders, or is it some set quantity that they have to pick up?
We've got some set parameters in terms of what is the definition of success. So sell-through percentages in their stores. So I think the test is about 4 months. At the end of 4 months, sort of we'll review the sales numbers, and if the sales numbers are satisfactory, then it goes to an all-door rollout. So yeah, I think I would say that 4 to 5 months from launch, which is expected to be in April, late April or May, is when we'll have a clear indication of if this is moving forward and what the size of the business will be for year one.
Okay, so initially it is 150 stores, and eventually what would it be, number of stores?
So again, those things will have to be discussed based on the success of the brand. I mean, they have, from what I understand, 3,000 to 4,000 stores. We'll have to see how many stores it goes into, depending on how well it does.
Okay, and all of these stores are running right now, due to even after the pandemic?
Yes, they are.
All right. Okay. Also, you've actually set up a ROE of 15% for the long term. So is there a time limit? Let's say you want to achieve this in the next, let's say, 3 years, or something like that. Initially you had given, but I think because of the pandemic, it may have got postponed.
Our expectation would be that in FY22 we should be able to hit that target.
Oh, all right. Okay, that's great. Okay, thank you.
Thank you very much. A reminder to the participants, to ask a question, please press star and 1. The next question is from the line of Mihir Desai from Desai Investments. Please go ahead.
Thank you for the opportunity. So my first question would be on the cash flow which we are generating. So, like looking at the cash flow generation, we are positive cash. And as you said, you are not planning to do any bricks and mortar expansion very aggressively. So how should we look at this cash flow like 2 to 3 years down the line?
So I would say that we've sort of a lot of the cash requirement for our business is for working capital needs. So I think that as cash flow generation does happen, we are likely to for the current year consider a dividend policy as well. We do realize that when we made the acquisition for a couple of years, we did have negative cash flows, but since the business is now generating cash flow, we would likely consider a dividend policy for the current financial year as well as going forward.
Okay, that's great, sir. You're thinking about the investors. So follow up on this. So basically, sir, when we are generating the cash flow, and do you see that our working capital requirements would reduce from now? The question I'm asking this because, sir, then we can see a sharp improvement in our ROCEs and ROEs.
So I think that that would depend on the business mix and what the contribution of the online business is to our overall business, because the working capital needs of the direct to consumer business are far lower than our wholesale distribution. So okay. I think if that business becomes a meaningful part of our overall business, the working capital days cycle may improve because on the wholesale side, I think we've controlled inventories to a level where I don't think that the working capital cycle can improve further. I think we'll see improvement to the numbers as our operating margin increases due to increased contribution from the licensed brands wholesale distribution as well as the direct to consumer business, because those businesses, we are in a better position to negotiate lesser working capital cycle with our retailers. And on the direct to consumer side, obviously there is no receivable days because money is collected upfront.
Okay. So, sir, do you want to throw any number on e-commerce or say online business, say FY22-23, like percentage of revenue or something?
I think that we would be able to give you a lot more clarity in the next quarter, because I think we would have seen the launch of Hallmark as well, and I think that currently because of the tailwinds of COVID, growth has been extremely strong. I think that as we sort of move forward and launch new websites, we would be able to give some guidance for FY22. I mean, but as you see right now, it's grown from almost zero. I mean, last year February we probably did less than 50 lakhs in sales to now a 70 crore, and in January 100 crore run rate business. So it's been extremely strong, the growth, and we should be able to give you some guidance for the e-commerce business in the annual after the annual numbers.
Okay, that sounds great. And sir, on the one on the accounting question which I had, like if we see this quarter our advertisement expenses, if I compare to YOY quarter 3 FY20, it has increased, sir. So can you please throw some light, like?
Yeah, so I think that we did not have any e-commerce business in Q3 of last year, which is why this is sort of the expense made towards advertising. The reason we sort of broke it up in the numbers is to sort of show that we're spending as a percentage of revenue a significant portion towards growing our direct to consumer business.
Okay, so so going forward this would be the run rate of our advertisement expenses. Is that what we can consider?
Yeah, so I think that we'll try to maintain 25 to 30% of direct to consumer revenues as advertising expenses. So we expect those numbers to grow as the e-commerce business grows.
Okay, so it would be with the tandem with the growth in e-commerce.
That's right.
Okay. Understood. So the EBITDA margins would be maintained at this level, right?
That's right. So the EBITDA margins on the direct to consumer business were about 16%. our expectation is going forward, we should be in the 20 to 22% range for the e-commerce business.
Okay, that's a great margin, which you can achieve, sir. And sir, just my last question on macro, sir. So how do you see the demand growing up, sir? Demand
So
is there.
I think that what we've seen is that there is some normalization. We are not back to 100% yet. So I would say that we are at 90 to 100% of pre-pandemic levels currently. I think that we are quite encouraged by the rollout of the vaccine in the US, which is our primary market, as well as in Europe. Hopefully, during FY22, we should see return back to normalcy and then plan growth going forward.
Okay. Sure, sir. If I have more questions, I'll come back in the queue.
Thank you.
Thanks.
Thank you. Participants who wish to ask a question may enter star and 1 at this time. Next question is from the line of Shruti Sharma who's an individual investor. Please go ahead.
Hello. Thank you for taking my question again, sir. So I have just one question on the lab-grown diamond business. So if you could give some color, what is the market size of this particular segment, and what is the competitive intensity we are currently seeing in this?
So I think the current estimates for the lab-grown diamond industry would be, I would say, single-digit percentages of the overall diamond business. I don't think that I haven't seen any authoritative industry data on specifically what the size of the market is, but most estimates are in single-digit percentages. I think it's really in its infancy and in sort of a growth phase, but it's early days yet. Definitely single-digit percentages of the overall business.
Okay, sir. And so who all are the players in this particular segment currently?
So there is quite a lot of players in the US. I mean, I would say Brilliant Earth is one of the companies that operates in this segment. Like that, there are multiple. Lightbox is one of the companies which is owned by Anglo American and De Beers, that is also in the lab-grown diamond segment. So there is a few. I think that none of them are at a significant scale, but I would say there is about 8 or 10 competitors who are focused on the lab-grown diamond space in the US.
Okay, sir. And sir, I just wanted to understand, what kind of revenue contribution is there from this lab-grown business segment in our business currently?
Sub 5%.
And are we targeting? Are there any plans to scale it up? And do we have any target for in near term, next to two to 3 years?
I think we'll have to see how the consumer responds to it. I think so far we are not seeing any indication that in the next 2 to 3 years it will become a meaningful part of our business. I think it just depends on consumer acceptance. I think we sort of have to keep our ear to the ground to see what's happening and whether consumers are responding well to the lab-grown diamond business. If they are, then I think we're sort of always looking at ways to grow the business, but we don't see any indication yet that it will become a meaningful part of the business in the next 2 or 3 years.
Okay, sir. Okay. Yeah. And that's all from my side. Thank you, sir. Thank you for answering the question. Yeah.
Thank you. Next question is from the line of Chirag Vekaria from Budhrani Finance. Please go ahead.
Yeah, good morning, sir. What I want to understand in this online business, what is your strategy? Would you be selling it from your own websites, or will you even sell it through websites like Amazon and all? And what is the working capital cycle in this segment?
Yeah. So currently, I would say about 90% of the sales of our e-commerce division are on our own websites. About 10% is as a third-party vendor on Amazon and other platforms like that. But our strategy is definitely going to be to try and sell on our own websites, because it's a lot more compelling storytelling. We have strong brands through Enchanted Disney Fine Jewelry, Star Wars, and the 2 new ones that we plan to sell. And the storytelling of the princesses and the entire Star Wars theme is a lot more compelling on our own website, and we are seeing a lot more success on our own website. So the working capital cycle, I would say, is about 4 months of inventory would be required sort of at a cost to cost level. If you compare it to sales, it's really under 60 days because there is high gross margin. So if I look at it from unit terms, it would be 4 months of sales, but relative to value of sales, it would be about half of that because of the gross margin. There is really no receivables because we receive the money upfront and then the product is shipped. So working capital cycle is relatively efficient for this for the direct to consumer side.
And sir, on the margin side, how would it would be from your own website and from Amazon?
So Amazon usually charges between a 15 and a 25% commission on sales. So that would be sort of the incremental margin that we would have on our own websites.
Okay, sir. Okay, sir. Thank you.
Thank you. Anyone who wishes to ask a question may press star and 1 at this time. Mr. Sumit Shah, there are no further questions.
Thank you everyone for joining us on the Q3 FY21 earnings call. We look forward to talking to you again next quarter. Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Renaissance Global Limited, that concludes today's conference. Thank you all for joining us, and you may now disconnect your lines.